Welcome to the Deep Dive. Today we're tearing into a really critical earnings call, one for a key player in enterprise automation. They just dropped their Q3 FY2026 results after the bell on December 3rd, 2025.
And this one wasn't just, another quarterly print. The reaction we saw suggests a major inflection point is happening.
Right.
For months, the whole story has been about this big transition, moving from, a pretty volatile RPA player to a much more steady, profitable, agentic automation platform.
And it sounds like management delivered on that message.
They absolutely did. And the market just bought the story, hook, line, and sinker. Shares were up, high single digits in extended trading.
So our mission today is to cut through all that noise, really distill the numbers, and unpack the strategic narrative that drove all that interest.
Exactly, because this is about more than just a good quarter. It's about a potential re-rating of the company.
Okay, so let's start with the hard numbers. This was a clear beat on the top and bottom lines.
A very clear beat. Non-GAAP EPS landed at 16 cents.
And that beat consensus by about 10%, right?
Right. And it represents a 45% year-over-year growth. So, that's some serious operating leverage starting to show.
Okay. And what about the top line?
Revenue came in at $411.1 million. That's a 16% annual increase, and it beat consensus by a pretty meaningful 4.7%.
And the key subscription metric, ARR.
Annual recurring revenue reached $1.782 billion. That's up 11% year over year. But here's the headline that really got everyone's attention.
The GAAP number.
The GAAP number. They reported their first ever GAAP profitable third quarter.
That is just huge for the credibility of this whole story. They swung to $198.8 million in GAAP net income?
They did. Now, we should say that was helped by some non-operating items.
Of course.
But the underlying discipline is what the market is rewarding. The rigor is real.
Okay, let's unpack that profitability story then, because discipline is clearly in fashion.
It is, and you see it most in the margins. Non-GAAP operating income hit $88 million,
Wow.
which delivered a 21% margin. That's an improvement of over 700 basis points year over year.
700 basis points. That's a massive shift in efficiency.
It is, and that commitment is what allowed them to get to GAAP operating income for the quarter, which came in at $13 million.
And that's a huge turnaround from where they were last year.
A massive turnaround from a $43 million loss. So this cost control, this execution, it's undeniable.
So this new financial rigor gives them the foundation to really sell the growth story, doesn't it?
It gives them the credibility, exactly.
So what do the subscription metrics tell us about the health of the customer base?
So let's look at net new ARR, which was $59 million. Management kind of framed this as a stabilizing quarter.
Okay.
But the real story is in the retention rates, because that's where you see the quality of the revenue.
We're talking dollar-based retention rates here, and these are crucial.
Crucial. The dollar-based net retention rate, or DBNRR, held firm at 107%.
So that's expansion minus churn.
Right. But the number I look at for platform stickiness is the dollar-based gross retention rate.
And that was...
It remains best in class at 98%.
Hold on. 98% gross retention is incredible. It basically means no large customer is leaving the platform.
The foundation is rock solid.
Exactly.
The 107% net retention then tells you the remaining customers, the high-value ones, are increasing their spend.
Even if some of the smaller accounts are churning out.
That's the perfect way to look at it. The big fish are showing deep conviction. Customers spending $1 million or more in ARR grew to 333.
And what about that middle cohort, the $100K to $1 million group?
Even better, their net dollar expansion rate was actually 113%. These big companies are betting heavily on this platform.
So you have stability, leverage, and a healthy balance sheet. They're debt-free with $1.5 billion in cash.
Right, and free cash flow was $28 million for the quarter. All this rigor just provides the foundation.
For the big story, strategic narrative.
Yes, and this is where it gets really interesting. This is the pivot.
Away from being just an RPA tool vendor.
Toward becoming the AI orchestration layer for the entire enterprise, the control plane.
The CEO talked about this a lot, right? A unified system for deterministic automation and agentic automation.
Specifically highlighting their Mystro orchestration engine.
So Mystro. It sounds like the AI nervous system for a company, coordinating models, humans, bots.
That's the pitch. And its key differentiator is that it's vendor agnostic.
Ah, so it doesn't care if you're using OpenAI, Google, or something else. It sits on top and directs traffic.
Precisely. The pitch is, don't let your AI tools live in silos. Let Mystro coordinate them all in a governed, secure way.
And that makes the traction numbers they shared way more compelling.
The traction is accelerating fast. Over 950 companies are now actively developing agents on the platform.
That's a huge jump.
It's a massive jump. And they reported more than 365,000 processes being orchestrated via Mystro. So this is moving from idea to production.
And what about the actual products driving this?
A lot of focus on UiPath ScreenPlay. It's key for blending that old school RPA reliability with the new LLMs to automate really complex UI tasks.
Okay, so making the bots smarter.
And making it easier to build them. They've enhanced Agent Builder with a visual canvas and templates. And then there's IDP, Intelligent Document Processing.
Which is always a huge pain point.
Always. Their EXP product now has agentic capabilities to handle really messy, complex documents, moving way beyond just standard templates.
This sounds like a great time to bring in the customer stories they mentioned to make this tangible.
The case studies were fantastic. They talked about a large investment management firm.
Right.
It expanded its use to over 260 automations, using Mystro to connect everything. The result, a 95% reduction in time to value for some workflows.
And projected savings in the tens of millions.
Potentially reaching $200 million over a few years. I mean, that is just massive conviction.
And we also saw some great results in healthcare.
Yeah, Corewell Health. They're using EXP to automate patient referral information right into their Epic system.
That's a huge bottleneck in healthcare.
A huge one. They expect to redirect $1.5 million in labor savings this year, growing to over $3 million next year. It's a game changer for patient flow.
And there was one more. USI Insurance Services.
Expecting over $32 million in savings over 3 years by using the multi-agent orchestration. So these are huge enterprise-wide projects.
And all this reinforces that trust and governance angle, right? It's not just about building cool AI, it's about reliable AI.
Exactly. Management was very keen to point out their leader positions in Gertler and Everest Group reports and their inclusion in Time's Best Inventions of 2025. It's all third-party validation.
Shifting gears a little, let's talk partnerships. Management really hammered home this idea of an open, flexible ecosystem.
Well, they have to, right? To be the orchestration layer, you have to play well with everyone.
So what were the key announcements?
Deep integrations with all the big players. Microsoft Azure AI Foundry, OpenAI for a ChatGPT connector, Google's Gemini models, and a really crucial one with NVIDIA.
Tell me more about the NVIDIA partnership. Why is that one so important?
It's about their NIM microservices. NVIDIA inference microservices are all about speed and trust for real-time workflows.
Like fraud detection.
Exactly. Or high-volume customer service. Integrating means they can run these complex AI models with super low latency on the customer's own infrastructure. It supports that whole governed high-performance AI story.
And they also mentioned Snowflake Cortex AI.
Right. For agents that need to work directly with data warehouses, the goal is to be the secure foundation, no matter what the customer's data and AI stack looks like.
What about their go-to-market? Did they talk about how they're actually selling this vision?
They did. They highlighted an expanded collaboration with Deloitte, and they noted this is driving higher quality pipeline.
Higher quality hell.
Specifically around large S/4HANA migrations. This is significant. It means they're getting involved in massive core business transformation projects, not just small departmental stuff.
That's a big move up the value chain.
It is. And we saw similar strength in the federal sector, which is a bit of a surprise.
You'd think that would be a volatile area.
Right. But management said they saw no direct impact from potential shutdowns. They pointed to projects with the U.S. Coast Guard and the VA speeding up disability claims. These are long-term, mission-critical things.
Okay, now for the part investors were really waiting for, the raise part of the beat and raise, the forward guidance.
They raised the numbers across the board. The Q4 revenue guide is now $462 million to $467 million.
And that's above street expectations, right?
It is, even after absorbing a roughly $3 million headwind from the Japanese yen.
And the profitability story continues.
Oh, absolutely. They expect Q4 non-GAAP operating income to hit around $140 million, so they're maintaining that discipline. And full-year free cash flow is still expected around $370 million.
Wow. So stability and leverage are the message. But let's talk about the elephant in the room.
If the stock is rallying this hard on the AI vision,
how quickly does that actually turn into revenue?
And that is the crucial tension. Management was very clear about this. Agentic AI is on an early stage adoption curve. The revenue contribution from all these cool new AI features is expected to be immaterial in fiscal year 2026.
Immaterial. So the stock is rallying purely on execution and conviction, the belief in the story?
That's it. It's a rally based on the long-term potential, not immediate AI monetization.
So isn't the market getting a little ahead of its skis here? This whole rally is basically a bet on fiscal year 2027.
That's the risk, and it's the open question. The market is giving them full credit for fixing the execution and profitability problems. Now the burden of proof shifts entirely to growth.
Can they convert those 950 pilots?
And can that momentum bend the 11% ARR growth curve back toward the high teens next year? That's what everyone will be watching.
Okay, that's the key metric. Time for our segment where we pitch a high-risk, high-conviction trade idea based on all this. And just a reminder, this is strictly not financial advice.
All right, so the setup here is really compelling. The options market implied a huge move for the stock on earnings, almost 12%.
But the actual move was a bit smaller, high single digits.
Exactly. So you're seeing a stock that has fundamentally stabilized its execution, hit its profit milestones, and most importantly, cemented a new credible platform vision.
So the market is still pricing in the volatility of the old story.
But the company is starting to execute like a disciplined, mature software company.
So how do you play that gap?
You fade the fear premium that's been attached to this stock for years. With the operational rigor now established, those high gross margins, the $370 million FCF guide, the extreme volatility being priced into the options market for the next few quarters just might be overstated.
So you're suggesting selling volatility, betting the stock won't move as wildly as the market thinks.
That's the trade. You could sell out-of-the-money straddles or strangles ahead of the Q4 earnings in March 2026.
A bet that stability wins out.
It's a bet that realized volatility will continue to undershoot implied volatility. You're capitalizing on the market, overpricing uncertainty, just as management is committing to sustain stability. A classic play on a former boom-bust stock that's found its footing.
That wraps our deep dive into the Q3 FY2026 earnings call. I mean, the key takeaways seem pretty clear. GAAP profitability is here, execution is stable.
And that agentic orchestration platform is showing really promising early traction, even if the revenue isn't there yet.
So the focus for investors shifts entirely to Q4 execution.
And getting confirmation that the $59 million net new ARR print wasn't a one-off, that it's a sustainable turning point. We need to see those 950 pilots start converting to real money.
Okay, a final thought for you to consider. If Mystro truly becomes this AI nervous system for the enterprise, coordinating every agent from every vendor, what's the realistic valuation multiple for the ultimate control plane of all enterprise AI workflows?
Thanks for tuning into the deep dive. And remember, this is not financial advice, just our in-depth exploration of the material. We look forward to hearing your thoughts.